Welcome to Markets in a Minute. My name is Austin Duke. I am financial advisor and chief investment officer for Diamondback Financial Services. We're an investment advisory firm focusing on clients who recognize a need for solid investment advice, who don't want to invest on their own, but still want to be educated through the process. This is the Monday, May 12, 2025 edition. Let's get started. All right, we'll start by looking at the stock market as measured by the S&P 500. This is an index of the 500 largest companies in America. Stocks will go up and down on a daily basis for a variety of reasons, and our job is to figure out what moves we've seen, why we've seen them, and where we think we're going from here. Over the last 2 weeks, we saw the stock market rise 2.44%, which reduces the decline that we've seen for the year to 3.77%. So still struggling here in the beginning of the year, but we have hope and expectations that the second half of the year will be much better for us. 2 weeks ago, we pulled up this longer term chart. This is a 1 year chart of the stock market. We were back here right around the 5,500 level at 5,525, and we put these red lines in saying that our expectation over the next 2 weeks and probably even the next 2 months would be to fluctuate around the 5,500 level, giving ourselves a 5% trading band designated by these red lines. So we did drift higher over the last 2 weeks, which is positive. We're seeing some announcements, some negotiations for trade deals that we believe is leading to these higher stock prices. But we also know that there are not things that work out the way that we think they will. So this can go back down just as easily as it's gone up. So we're kind of in this trading range where our expectation is as stocks go up and we are approaching the top of that trading band, we would be looking to rebalance and maybe sell out of some of the U.S. stocks and buy into some of the international stocks. And then if we see the U.S. stock market come down and maybe even come down closer to that 5,200 level, then we would rebalance again. The rebalancing strategy works really well when we're in a trading band like we think we're going to be. So it would not be out of the ordinary for you to see a little bit more activity in your investment accounts, assuming that we do remain in this trading band as we expect. Next, we'll look at interest rates as measured by bonds issued through the U.S. Treasury Department. We believe that interest rates are the preeminent measure of investment risk. Rates are factored into every investment calculation, including stock valuations. And generally speaking, lower interest rates will lead to higher stock prices, and higher interest rates will lead to lower stock prices. Those rates will also move on a daily basis for a variety of reasons. So our job is to see what moves we've seen, why we've seen them, where we think we're going from here, etc. On this chart, we've got interest rates listed over here on the y-axis. We have maturity lengths listed on the x-axis from 1 month all the way out to 30 years. And so each dot on this chart represents an interest rate for a given maturity length. Solid green line is where we were as of Friday, May 9th. Brown line is where we were 2 weeks ago, and the dotted green line is where we were 1 month ago. So as we have gone from the Liberation Day reciprocal tariff notice through the month of April and now into May, we've seen these interest rates pretty much on the medium to long term, and we've seen those decline significantly and then basically come back almost in line with where we were just a month ago. So not a lot of change to interest rates, and even less change on the short term range of the yield curve. The Federal Reserve did have their meeting on Wednesday the 7th. They did not make any changes to the federal funds rate, which was anticipated. So this is as of May 6th. Here's what we were predicting, the probability that we would see a cut to the interest rate was basically a 1.9% chance. And at that time, we were looking at about a 34% chance of an interest rate cut at the June meeting, and 100% chance that we'd have a cut by July. Now, after they made their announcement of no cut here in May and then had a press conference following, suggesting that they are in no hurry to cut those interest rates again. Now we've cut this probability in half. It was about 34, now it's 17% that we would get a cut in June. And instead of 100%, now we're about 2/3, about 69% for July. What's interesting though is that we are fully pricing in a cut here by September and another, just about another in October, and then another here in either December or January, by January, a third cut. So we have been maintaining since the beginning of the year that we are expecting 3 to 4 cuts. Uh, we have our own opinion about whether or not the Federal Reserve should be cutting interest rates. We would suggest that a 0.25% reduction in the Fed funds rate is not going to be significant enough to have a dramatic impact on inflation. And we think that it would have been a lot better for them to have done it. We would like to see them cut in June as opposed to continuing to wait. We feel like the longer they wait, the more likely it is that we're going to see a deterioration in the economy before they try to come in and who knows, maybe instead of cutting at 0.25% and taking smaller cuts along the way, they'll come in and do a 0.5% here in September, October, and make it a bigger cut instead of just doing smaller ones. So that's one strategy they could be considering. We think that it would be better to do smaller cuts along the way, but again, that's where we are in interest rates. Okay, for our investment implications and expectations portion, there's just a ton that we could cover and it would take hours. I keep a document up during the week and I try to make notes of things that are coming through in the news or economic data that I might want to hit on. And I've got a couple pages worth of information. So some of that will be in the newsletter, but we really just don't have time to go through everything. But what we'll try to focus on are the things that, again, we think are the most important. So we've seen a couple things in the news, right? President Trump hit his first 100 days. He had a rally in Michigan. He offered some tariff relief to automakers as part of that. They did sign a rare earth minerals deal with Ukraine, which we think is a way for them to try and, over the long term, reduce the cost of raw materials, have a U.S. presence in Ukraine without a military presence, and hopefully bring an end to this war that has been going on and prevent Russia from future skirmishes. My son kept asking, if China and the U.S. were having discussions about tariffs, and even though openly in the media there were denials of any talks going on, I said absolutely. Somebody is talking, and whether or not they're playing some kind of gamesmanship of we don't want to be seen as the first ones, succumbing to the other, they're talking. So the approach to these tariffs is softening. As of this recording, we know that the Treasury Secretary and his counterpart in China are meeting in Switzerland today. We don't have any news on how that meeting's going yet, but we assume it's not going to be as good as people might hope. We think that there will be some ongoing negotiations. We think this will be a little bit of de-escalation. I think they've been pretty clear going into this meeting what the outcomes are, and so I don't think we're going to have any kind of a trade deal or even a framework. I think this is just finally we're getting acknowledgement that we're having these conversations. And so I would not be surprised if the market's down on Monday or even next week because this doesn't go best case scenario, which I think the market may have been hoping or expecting. We did have what we'll call a short skirmish between India and Pakistan because as of this morning, we got news that there's a ceasefire that was announced. The new Canadian Prime Minister came to Washington, D.C., met with President Trump, and they're talking about trade negotiations. So a lot of trade negotiations going on, right? Dozens of countries allegedly are working through these tariffs with the United States. And I think what we saw back in April, a month ago, was worst case scenario, right? President Trump came out and basically said we're going to have 10% across the board tariffs, and then he pulled out his big board of reciprocal tariffs, and each country was listed with an even higher rate. So I think that's worst case scenario. Best case scenario is going to be that 10% across the board, and what we're probably going to end up with something in the middle for every country. So going back to the Federal Reserve meeting on Wednesday, that's one reason why we think it's a bad idea for them to wait and see, because we already know the tariffs are going to be higher. We already know that there's going to be some impact on pricing and economic growth, and just sitting and waiting to see what happens at this point, we think is a bad idea. But hopefully, they know more than we do, and that they're doing the right thing. Um, so the Treasury Secretary did also testify before Congress, and one of the things that I remember him saying to one of the senators or congressmen was something about the structured, what is that, uncertainty, or he's referring to game theory, and he's talking about the uncertainty that they're using to their advantage, right? Because right now, like, nobody's telling us what's happening, right? There are trade negotiations going on. We have no idea what those tariffs are going to look like. We've got the Federal Reserve saying we don't know what's going on. We can't make an interest rate policy until we know what the tariff rates are. And we've got companies reporting first quarter earnings, which look good, but when they're forecasting the future, they're not giving us anything there either. Some are completely pulling those forecasts. Some are giving us different scenarios. Some of them are trying to just figure out what's going on. Um, and that's why, again, the stock market's going to fluctuate based on headlines that are coming out. And if they're good headlines and we have progress with companies like or countries like China and others, then we expect the stock market to go up. If it doesn't meet our expectations, or whoever's making the big bets with the big money, then we would see a stock market decline. But again, I think that's the main driver for the market being in a trading range for the foreseeable future. Now we are quickly approaching, in my opinion, the 90 days, the delay that President Trump put on those reciprocal tariffs. So we're still going to see around Independence Day in July, we're going to see those come back into play. And so if he doesn't get his way, and we don't get tariff deals or at least frameworks with different countries in place, then we expect those to come back on, those worst case scenarios. So hopefully we are getting more deals between now and then, and we have a smaller probability of that worst case scenario, right? The United Kingdom, the UK, they announced a trade deal with President Trump on Thursday. As part of that press conference, again, President Trump says, ahead of this meeting with China on Saturday and ahead of the budget bill that they're expecting to pass by July, President Trump on air says, it's a great time to buy stocks. And he said that a month ago, right before he delayed the tariffs. And so that's one reason why we think that the stock market went up over the past 2 weeks, is because, well, I guess he just said that on Thursday. But if you look at the chart of that stock market on Thursday, you can see when he says it, the market goes up significantly. And so you have to assume that, whether or not that's legal or illegal for him to say, there's power behind what he is saying on air, uh, out in the public. So the Treasury Secretary is telling us that the debt limit is going to be reached by August. We need to get this budget bill passed. President Trump apparently is okay if we go with a higher tax rate on people making more than $2.5 million. That might be something that could be negotiated in this budget bill that would help Democrats approve the bill, because we know that that's something that they had been pushing for when President Biden was in office. So again, and that's just the news, right? Like, we could go into all the economic data. We could talk about how GDP was negative, but it was mostly just because imports had been pulled forward ahead of the tariff announcements. Um, but by and large, I mean, the economic data still looks fine. It's not great. I mean, it's not like what you would see if we were coming out of a recession and the economy was just firing on all cylinders. Like, we're basically in cruise control. We're still doing fine, and we're not seeing anything that I'm necessarily concerned about. I feel like a lot of the economists that I follow, who had been pretty positive on the economy for the past couple of years, are now saying, well, growth is slowing, and we're seeing signs of slowing. That doesn't necessarily mean we're seeing signs of recession or depression or anything. It just means that things aren't quite as good as they could be, or would be if we were coming out of a significant slowdown. And so this is what we would refer to more as like a mid-cycle or a late cycle type of economy. That doesn't mean that we are headed into a recession necessarily. It just means that things aren't growing as quickly as they had been. Anything else that I wanted to highlight? But no, I think what we're trying to pay attention to, and I'll see if I can pull this up on the computer. The last thing that I just want to mention. So I have the list of economic data that is available. I mean, some of this stuff comes out weekly, monthly, like almost every single day, we've got some kind of economic data coming out. I showed this before, but some of this is pretty relevant to what we're concerned about. Some of it is not. But some of this stuff is published weekly, monthly, quarterly, etc. One of the things that we look for, if we're trying to derive what is going to drive our economy, we believe it's employment. It's people who are employed, they're making money, they're spending money, and they've got confidence that they're going to still have a job so that they can make bigger purchases or, put things on credit or go on those vacations and book those hotels and stuff like that. So if we were to try to derive this is not the only thing that we can look at, but this would be, in our opinion, one of the biggest contributing factors to economic growth. And you can see there's seasonal factors. So each of these blue bars is our unemployment initial jobless claims. So if you lose your job, you file unemployment, you get a little bit of money while you're looking for another job. We see there are seasonal trends, right? As we go through the summer, there are fewer initial jobless claims as we go towards the end of the year, and especially in January when all those seasonal employees are no longer needed for the Thanksgiving and Christmas holidays. We see a higher number of people applying for unemployment. But if we were to look at the blue line or the blue bars, these are not seasonally adjusted numbers. This white line is if we were to adjust for those seasonal factors, here's an average of what those jobless claims would be. And then the orange line is just a straight 4-week moving average of those non-seasonally adjusted numbers, right? This is pretty low key. I mean, there's a little bit of ebb and flow, but I mean, there's not a lot of change here. Everything still seems to be going just fine like it has been for the past 3 or 4 years. So, and this is stuff that comes out on a weekly basis. So if we get concerned, like this is the first thing that we would be looking for is a jump in these numbers that would not be normal for this time of year, or it would be greater than it would be for, as we get in toward the end of the year, et cetera. So that's where we will leave it for implications and expectations, right? Kind of the same expectation that the market's going to fluctuate a little bit over the next couple of weeks, and until we get more clarity, more certainty on what these final tariff policies are going to be, we think the market's just going to react to whatever headlines come out on a daily basis. All right, as a final word, I heard an analogy this week that I thought fit pretty well. I've also seen it going around on social media that if you go grocery shopping and you're bringing in the groceries, that it's pretty macho to be able to bring in all of your groceries in one trip instead of having to go in and come back and get more groceries from the car. So the analogy was that trying to carry in all these groceries in one trip is like trying to consume all of the news that is coming through on a daily basis. So this year, the new administration, everything that's coming out every day is it's a lot, and we're doing our best to carry it all in on one trip and then condense it all so that we can highlight the relevant stuff. So we know that there are times that are more volatile, more scary, and make us more nervous and more anxious, and hopefully that we can continue to get through it together. And if you have questions, let us know. We're also going to be sending out some performance reports just so you have an idea of how things have been going for your accounts. We think all things considered, things are going relatively well. And we're still hopeful and optimistic that the second half of the year will get better once we can get back past tariff stuff and budget stuff and debt ceiling stuff. I think, again, hopefully, fingers crossed, things are going to look a lot better, and otherwise we'll make some changes. But yeah, we hope you guys have a good Last couple of weeks here, or next couple of weeks, from it'll be the last couple of weeks of school for me and my kids, and just kind of crazy to think that the next time we do this will be Memorial Day. So enjoy your time, and we'll see you soon.